And then there is a middle world, which is quantamental. Quantamental is also a widely popular strategy globally. It uses quant to filter down from say 500 to 100 stocks or 500 to 50 stocks, and then the fundamental manager has to use his overlay.
Is it the PSUs? Is it the private banks? Is it the gold specific NBFCs, or it's the other NBFCs intermediaries? Where is it that you find your alpha in?
Playing on this very principle, we've designed our strategy that we cannot control what will happen in the market. That is not in anybody's control. What we can control is how we will respond to these changes.
Hello and welcome to Returns and Beyond. My name is Narender Agarwal from Wealth1, and this is a podcast for PMS, AIF, the space of alternates, and the journey to create wealth. Friends, today we have a very special guest, Mr. Siddharth Vora, who is the fund manager and also the head of investment strategy at Prabhudas Lilladher, running 3 PMSs successfully. So let's welcome him to our show. Hello, Siddharth, and welcome to Returns and Beyond.
Thank you so much, Narendra, for having me. I've been looking forward to have this conversation with you, and you guys are doing a fantastic job.
Thank you so much, and likewise,
Yeah.
the compliment is for you also. So, Siddharth, moving on to our podcast and understanding this financial markets and understanding what happens with the mindset of a fund manager. Uh, we have seen that you've been talking about quant investing a lot, and you have been a soldier to propagate quant investing. So, what exactly is quant investing? If you can tell us in a very, very simplified version for our viewers to understand.
Sure. I think the most simple way to understand what quant investing is that you're delegating investment decision making to a machine.
Mhm.
You are teaching the machine what the rules should be, how it should process data, what kind of outcomes would have played out over the last say 10, 20, 30 years. But finally, you're setting rules as a man, and you're allowing the machine to follow those rules. So when you spoke about the word mindset. So the whole idea is when you go to quant investing, your mindset is that you don't have to have a mind of your own, you don't have to have emotions of your own. You have to let the machine take the decisions, but of course you can't leave it entirely on the machine. You have to design the rules and you have to let the machine follow the rules. So there are a lot of examples of quant in our day-to-day lives also, that we see.
Mhm.
From simple things, like booking a hotel online, you apply 20 filters. This is my budget, 4-star, 5-star, location, number of rooms, number of things, right? Breakfast included, free cancellation. So all of that, you're using rules to narrow your universe. If there are 1,000 hotels in a city and you want to select your top 5, you will use some sort of rules to arrive from 1,000 to top 5. Of course, in investing, it's a little more complicated than that, but this is the essence. I think your wife also must be using some principles of quant investing in her day-to-day life, whether when she's shopping from Amazon and Flipkart. When she wants to buy new products, she'll be using some filters, right?
And when she's wanting to manage me also, there are a lot of filters that come in.
I think no filters apply in that. That is the only aspect where quant
Where
can't
God
work.
cannot work.
Nothing
Yeah.
can work. See, not my words, but the late great Mr. Rakesh Jhunjhunwala, he used to say that markets and women, you can't predict either of them. So I think even quant can't predict the markets. It can just respond in a slightly better way. That's it.
Yeah, yeah, yeah.
And nowadays with YouTube and AI, you have recipes for everything.
Mhm.
So imagine, say 15 years back when you didn't have access to this, you had to cook with your experience or judgment, as opposed to cooking with recipes. So recipes are nothing but a set of rules that you need to follow. So that is the difference between quant investing and active investing. Active investing involves a lot of judgment, experience, intuition,
Mhm.
understanding. It has a big qualitative aspect to it. Quant investing, on the other side, is objective, process driven, rules based, mathematical, and well defined. So both are very good, both are different, and both have different pros and cons to it.
Absolutely, point taken. But I need to understand that when you narrow down your universe to the last five, then of course there has to be some kind of an intervention, a human intervention that is coming from experience, who will finally decide that now this is the one that I want to click on.
Sure.
So how
So,
does that play out when you are mostly dependent on the quant advising you?
got it. So, there are three types of strategies, right? One is fundamental strategies, where there is no involvement of quantitative processes. Everything from sector selection, stock selection, allocations to sectors, allocation to stock, when to buy, how much to buy, when to exit, allocation between large cap, mid cap, small cap. All these decisions are taken actively, basis discretion, basis research of the fundamental fund manager. Then the other extreme is pure quant.
Hmm.
Every decision that I spoke about here is taken by the machine. It's not just about filtering. The entire portfolio construction, stock selection, allocation, sector selection, sector rotation, everything is 100% machine driven. And then there is a middle world, which is quantamental. Quantamental is also a widely popular strategy globally. It uses quant to filter down from, say, 500 to 100 stocks or 500 to 50 stocks. And then the fundamental manager has to use his overlay to select 20, 25 stocks from that shortlisted universe of 50 stocks. So at PL, currently, we are running all pure quant strategies. We don't use it just to filter stocks. We use it to build the entire portfolio end to end, from allocation, selection, exit, entry, everything.
So that means there is no manual intervention
No,
that plays into
no,
your
not
selection of.
not in the current funds that we are running. We're launching a new AIF fund though,
Mhm.
which is going to be our first quantamental fund, where quant helps us narrow down from, say, top 750 stocks to top 100 stocks. From those 100, how to pick the top 25, 30 stocks is going to be done actively by our fundamental fund manager, active
and
fund
and when
manager.
do we see this AIF coming and
In
seeing
the
the light?
next, latest in the next 3 months.
Wow,
We already
wow,
started the paperwork and process to launch it.
wow! Wishing you all the best for
Thank you
this
so much.
AIF, and I hope that it does
Yeah.
really really well. Uh, Little bit. Let's take a peek into your war room,
Mm-hmm.
okay, your office, where the quant is at play. Okay, so if you can walk us through the journey. Okay, so these big words look very nice, that we are doing this analysis and that analysis to narrow down the stock. That's fine, but then how does that journey play out? Like selecting a sector, then going to a stock, and then what you always talk about, the right size, the right time, the right stock, the
Yeah.
right sector, and most importantly the right time to exit.
Yeah.
Yeah. So what how does that stock play along in your portfolio is what we want to understand.
So in AQUA, which is our equity fund, it's a flexi cap equity PMS. It only invests in stocks, top 500 by market cap in
Mhm,
India.
mhm,
So there are two journeys here, right? One is the journey of how the universe of 500 stocks converts into a portfolio of 30 stocks. That is one journey we need to understand. The other journey we need to understand is also how we started the entire quant setup and how we build the entire quant process,
mhm.
because you need the kind of analysis. You said that there is this analysis, that analysis. It's actually the team behind the quant processes or the quant models that helps us develop all this. So this is a very different kind of team, right? You have data scientists, statisticians, mathematicians, economists, Python programmers, CMTs,
Mhm.
fundamental analysts, CFAs, FRMs, risk analysts, risk engineers. So it's a completely different type of team setup that is needed to build quantitative strategies as opposed to fundamental strategies. So it's important to know that over the last 5 years, we've been able to build a really solid team of people to bring these different dimensions of stock selection, market analysis, portfolio construction in our system. So that has been the first and the rather difficult journey. The second journey is a byproduct of the first.
Hmm.
And the second journey is quite logical and quite simple. There are a couple of dimensions of the market you need to understand in order to construct your portfolio. So, first, we need to understand which macro and market regime we are in. If we are in a healthy macro condition and we are in a risk on market environment, your portfolio would look completely different as opposed to weak economic conditions and a risk off environment in the market. So, we call ourselves an adaptive strategy. It adapts to changing market cycles, macro cycles, valuation cycles, risk cycles. So, let's understand this process. It starts with a gauge on what is the current risk regime we are in. Are we high risk? High risk means risk on, we should take risk. Are we risk transition, which means if you are in high risk, you need to moderate the amount of risk you're taking. If you were in risk off and we are in risk transition, that means the risk appetite is now recovering. You need to take a little more risk. So basically, there are three regimes in the market: risk on, risk transition, and risk off. Risk on and risk off are fairly straightforward in terms of how you will approach them, how you will construct your portfolio. So the decisions we make is, first is market regime, second is style or factor regime. There are a couple of different factors we use for investing, so understanding that is very critical. Third is what type of sectors we want to invest in: cyclical sectors, non-cyclical sectors, high beta sectors, low beta sectors. Then is what should the portfolio's beta be? It should be more than 1, which is in a risk on market, less than 1, which is in a risk off market, and around 1, which is in a transition market. And then finally your stocks come in. Within Quant, there is a widely popular approach globally known as factor investing. Factor investing is nothing but we look at factors like quality, value, growth, momentum, risk, size, liquidity, dividend, theme in order to select stocks. Every security is rated on these different factors, and the stocks that come out on top in terms of a total score become a part of our portfolio. Now, this sounds very simple, but the art and science here is how much weight to give to which factor at which point of time. You can't give equal weight to all factors at all points of time. It doesn't work. So, when interest rates are increasing, value factor does very well. When there is abundant liquidity in the system, momentum factor does very well. When there is uncertainty in the market, quality factor does very well. When there is a bear market, low risk or low vol factor does very well. So you can't have one portfolio or one size fits all approach. You have to dynamically shift the weights from factor A to factor B to factor C and balance this as the market cycles evolve. And that is why we try to navigate changes in our market environment by changing the factor weights. So essentially, in one word, we are a dynamic multi-factor strategy where we are using multiple factors to make investment decisions, but the weights to these factors keep changing based on market conditions.
So, what I understand from your entire strategy of how the quant works, one thing is very clear that an individual investor, it's increasingly difficult for him to navigate through these financial markets,
Right.
and he has to fall into the quantitative analysis which the PMSs or the AIFs are
Yeah.
doing, and they're
Yeah.
having the data to back it up
Yeah.
For that capital protection that is required. And we see that a lot of times people come up and say, oh, I made some money in the financial markets, and then at the same time they come and say, we lost a lot of money in the financial markets.
Yeah.
And I believe that this is the basic difference, that the entire set of analysis has not happened.
Yeah. So Quant gives you a holistic view on markets, sectors, macros, stocks, and it also gives you a systematic and repeatable approach.
Yeah.
Both these words are very important. Systematic means it's defined to the T, And repeatable means a strategy that adapts on its own.
On its own, yeah.
That is repeatable.
Yeah, yeah,
if you fix something, that is not repeatable because conditions change every day. So we know that change is the only constant in markets and in life.
Yeah.
So playing on this very principle, we've designed our strategy that we cannot control what will happen in the market. That is not in anybody's control. What we can control is how we will respond to these changes. So our response can be controlled. What happens to the market cannot be controlled.
Is not in
and that is
anybody's
why
control.
being adaptive is literally the only way to survive the markets. There's no other
Yeah.
way.
Yes. Okay, so let's shift the focus on your PMSs and the portfolios that you are holding. We want to understand your sectors. Okay, so when I was looking at your fact sheets, I saw financial services having a major chunk. Yeah. So is it the PSUs? Is it the private banks? Is it the gold specific NBFCs, or it's the other NBFCs intermediaries? Where is it that you find your alpha
Okay.
in these sectors, or where are you more inclined towards? Is what we need to understand.
So, this is a great question because you've touched upon the topic of sectors. To deep dive in this, the first principle in any quant strategy is the principle of sector rotation.
Mhm.
Quantitative models use multiple different data points which try to, give you a perspective on risk, on valuation, on growth, on statistical parameters, on momentum, on breadth. Multiple parameters are evaluated for every sector to understand which sectors we should be in at any given point of time. But in simple terms, we want to be in sectors where the risk reward ratio is good. Mathematically, quantitatively, statistically, it should be good. In the last, let's just talk about this year, right? FY25. We started, January with an overweight in financials. At that time, the overweight was private banks and private NBFCs. We did not have PSU banks or PSU NBFCs. We just had private banks and private NBFCs as a big overweight. HDFC, Kotak, ICICI, Bajaj Finance, Muthoot Finance, all of them were there in the portfolio. Why were they in the portfolio at that time? Do we love those stocks? And that in a quant, you literally don't like, love, hate, dislike any stock. It doesn't matter to you only which stock is coming in or going out of the portfolio. So we're not concerned with being emotionally attached to any stock as such. But these stocks were in the portfolio. Why was it? We'll have to go through that same decision making process. What is the risk market regime? What is the macro regime? What is the sector regime? What is the factor regime? All of that tells you which sector should come in. So that time economic regime was, there was a mid-cycle dip in India's economy. So it was weak, neutral to weak. It was not as strong as we were. So before that 4 years, the economy was accelerating. Then we started decelerating a bit. The market regime was clear risk off, low risk environment, defensive. Sector regime was invest in low beta sectors. Don't invest in extremely cyclical, high beta stocks. Factor regime was high quality, low volatility stocks. That was the factor regime. So if you combine all of this, what are you getting? Are you getting PSU banks? Are they high quality, low volatility? No, they're not. Are you getting infrastructure lenders? Are they high quality, low volatility? No. So you're pretty much getting the cleanest stocks in that environment which were relevant. HDFC, Kotak, ICICI, Bajaj Finance, Muthoot Finance, etc. These guys were high quality, low volatility, and low beta in nature. And that's why they made it into our portfolio to align to market conditions. We held that position for a good 4 to 5 months, 4 to 5 months. We booked profits, we were out of it. Then our models signaled closer to April, May that things are changing. Now you need to start increasing the amount of risk you take. Market conditions are looking healthy. Factor regime is changing from quality and low volatility. Again, the weight of momentum, growth, value is increasing. So take a little more risk. We were extremely defensive. It told us to become little aggressive, not very aggressive, just little aggressive. That's when within financials, we exited all these companies and moved to our next theme within financials. which was asset management companies, capital market plays, NBFCs, but second order NBFCs, not your Bajaj Finance, Muthoot Finance wala NBFC. Why? We got the signal from our models that increase the portfolio beta. If markets recover, you want to keep your beta higher so you recover faster, right? That's the simple logic. So in order to increase portfolio beta, you need to change the kind of stocks you have in the portfolio. So then we move to names like HDFC, AMC, Nippon Asset Management, Motilal Oswal, BSE, AB Capital, LTF. All these names became a part of the portfolio and they've played out phenomenally well in the last 3-4 months since we've been holding them. So that was within the same sector, we changed the theme, we changed the beta.
So just a top-up question on that. Private sector banks have been sideways for the last 3 years. Right. Even when you said January was the right time to set
Jan to 4-5 months, we made good 10-12% return in that holding.
Yeah.
In that period, the markets were flat. But so a 10% return is also very good in a narrow range market.
But seeing the gold, the way gold is playing out and way Muthoot and Manappuram, the gold specific NBFCs are playing out, do you think that it was the right time to exit them?
Probably. Private banks, the exit was really good. Muthoot, I think we could have still held it for
a longer time.
A bit longer, simply because post our exit, globally, of course, US, there's been a better prospect of rate cuts playing out. So in a rate cut environment, gold does better. In an environment of geopolitical stress and inflation, also gold does better. So right now, with wars, rate cuts, trade wars, gold is a solid asset to have, which we hold in our multi-asset fund. We've had 25-30% gold since last 1.5 year now. So in a rising, gold environment, gold NBFCs naturally do better because they're, without getting new clients, they can just lend more to the same client because of the loan to value ratio, right? Yes, your gold price is going up, so you can just lend more simply.
And you're more safe
exactly
as a company.
Exactly. Yeah? So Muthoot particularly, I think we could have held on for a little bit longer. But because I told you, right, risk regime changes means get out of extremely defensive names and go to slightly more aggressive names. So that's why Muthoot, being an extremely defensive tier A top quality gold financier of India, that went out and other stocks came in.
Okay, so just digging into the rate cut. So, a Fed rate cut is just around the corner. As we talk, probably the memo will be getting typed and signed.
Right.
So, and also metals and minings is your second favorite
that's
sector,
been a big over
at the moment. So, how do you see the US Fed rate cut coming up, and is it going to affect the metal mining, and how do you see this playing out in the next 3 months, 6 months, this entire scenario of rate cut? Because frankly, for US, they are stuck in a situation where they're saying that yes, we want a rate cut to fuel the growth, but at the same time, the rate cut is going to also fuel the inflation.
Right.
So they are in that catch-22 situation where they cannot take a sound decision. But this rate cut that is now coming up is going to majorly affect the metals and mining sector. So how do you see this playing out?
In terms of rate cuts, I think the world, US, the Fed commentary and direction and all the research. See, I'm not a part of Fed, and neither I am a genius that I can make these predictions. This
even Trump is not part of Fed. Yeah,
nobody can control it. Yeah. But I think basis whatever I'm reading, right, whatever news and reports I'm reading, the likelihood of rate cuts is now slightly higher, and that is why there's a cheer in the markets also. Usually, emerging markets do very well in times of rate cuts. Only in the last 6 months, India has been an underperformer because all the foreign flows moved to China, South Korea, Taiwan, other emerging markets, not India. And despite rate cuts, despite India's extremely stable macros, we've borne the brunt of relentless FII selling. I think that is going to be a big trigger. I mean, this is going to reverse big time from here because tariff uncertainty is also reducing. And the reason so much money moved out of India to other emerging markets despite rate cuts was India's valuation. So if you look at, say, China, Korea, and Taiwan, they trade at a significant discount to India. So for the growth, India's valuation seems okay. But relative to peers, India is still quite expensive.
Hmm.
So in a time when there is tariff related uncertainty focused around India, people can say, okay, from a sentimental perspective or a risk perspective, we don't want to take extra risk and pay a premium valuation. So as the tariff risk subsides, our valuation premium will hold, the FII flows will come back. Now coming to metals particularly. So metals is obviously, it's not a domestic cyclical, it's a global commodity, it's a global cyclical. There are a couple of things that drive metals. Of course, lower interest rates fuels demand theoretically, so it does well, metals do well. No incremental supply coming in the world, no major incremental supply also does well for holding metal prices. uh, Weak dollar does is a big beneficiary. Metals are a big beneficiary of weak dollar because metals are priced in dollar. So if the dollar becomes weak, mathematically, your prices go up. You need more dollars to buy the same quantity, right? So your prices go up. So we are mainly bullish on metals for 4 or 5 reasons. One is the view on dollar is that it is likely to stay subdued. The XY is likely to stay subdued. Interest rates are likely to come off. Global demand is likely to recover. China supplies, there are no new supplies coming in China. At the same time, there is a lot of factories have been shut down as well. India particularly is nicely covered from a safeguard duties perspective. So the whole dumping risk is also managed for now. And finally, our quantitative models are saying that this is a sector where the beta profile is aligned to market's risk profile at the current point of time. The risk and return metrics are also suitable, and from a valuation perspective also, this sector is not expensive. So from a valuation, return, risk, beta, and fundamental triggers, this whole sector is coming nicely in our model. So that is why we have a significant overweight on the metals and mining sector. But if the position plays out in the next 1, 2, 3, 6 months, our models can chuck this sector out and go to a new sector. Or if the market risk profile changes, this is a high risk, high beta sector, right? So if the risk profile changes, we can exit this and go to a defensive sector like healthcare or consumer staples or whatever.
So when you say that you're going to your quant model is going to immediately check out a particular sector depending on the how the macros and the micros are playing. So what is your churn ratio in your PMS? How many times do you
So
really?
on an annual basis, you could assume churn between 200 to 250% at the portfolio level.
So
This
that's
is a
around
high churn.
2.5 of
Yeah.
churn.
So quant strategies usually will have a layer and element of churn.
Churn.
You can control it, manage it, reduce it, but you can't avoid churn in quant strategies because the strategy is feeding off data. If there is chaos in the market, if there's volatility in the market, if there's choppiness in the market, your data also keeps changing. So models in that period will have higher churn. If there is stability in the markets, if there is persistence in factor trends, in sector trends, quant models will keep holding that view for some more time.
Okay, so talking about the chaos in the market,
Jan, Feb,
yes, and
March, chaos.
so this entire chaos is also pegged to one word, and that is tariffs.
I would say that is Trump.
Yes, so all the TRs are into the same thing, yeah. So pharma is also one of the sectors that you hold very dear to. Uh, the
Neutral.
CDMOs.
We have very low, I mean, 8-9% allocation to healthcare. It's not a major overweight yet.
Okay, so is it because of the tariffs uncertainty? Because when the tariffs were levied on India, at that time, pharma was kept out, and then after a few days, it was rolled back into the tariffs scenario, and then kept out again. So the entire thing about tariffs on pharma is playing out to be very, very in a vague and the confusion zone.
Right.
Exactly the word chaos is. So how do you see this sector moving forward? And do we really get that China benefit coming in, or is it all washed out?
So when a quant model picks a sector, the quant model is not aware that there are tariffs going on in the world and this sector is going to be impacted by tariffs. All the data that it processes, it tells you that, okay, 60% of your portfolio right now is high risk, it is cyclical. You need some diversification and hedge also in your portfolio. So, from a risk perspective, healthcare is a low risk sector. Pharmaceutical companies within that also that we've picked, our models have picked, have a lower exposure to US, pretty much sub 20%. So, from a valuation, volatility, momentum, and growth perspective and quality perspective, these stocks stand out tall. So, in a portfolio where majority of your portfolio is trying to take aggressive calls in the market to play the recovery, you also need some diversification and hedge that if this doesn't play out, some part of your portfolio is going to hold your ground. So, pharma is currently in the portfolio from a hedging, diversification, reducing portfolio risk, reducing portfolio volatility perspective. It doesn't really care about tariffs per se. If your portfolio of pharma stocks is not tremendously exposed to US pharma or US sales, then you're going to be okay. It's not, if you're India focused, LATAM focused, Europe focused, you're quite
For
well taken
example,
care of.
the hospital sector, the medical tourism sector,
Right.
or the sector that is more domestic in nature,
Yeah. That should
i-
hold out better.
hold out better in the pharma sector. Is what I understand
Yeah,
correctly.
yeah, yeah.
Yeah.
But we don't
Okay.
have any positions in hospitals. The valuations, our models are not comfortable with. So,
Okay. Okay. So now, moving to a little bit of international macros and how India is playing towards the international scenario. So my question is not to the quant model. My question is now to the fund manager, Siddharth. Okay. Uh, we've seen the India UK FTA. Okay, and this is how the macros of India are sounding to be in place. So we have FTA, we have the best of the relations with China ever,
not best, improving.
improving by the day. Mm, we have the deepest of the relations with Russia. Okay, we have the crude at less than $70. We have a further 5% discount coming from Russia on the crude. We have the trade of crude happening in ruble, yuan, and rupee. That is kind of making our forex reserves intact. Yeah, uh, all these things are playing out to be making India as a very solid base and a ground for the economic macros that we can figure out.
Yeah.
Now there's a missing piece in this puzzle, and that is the India US trade deal.
Yeah.
Yeah. So I want to understand, what is your view on this. This deal goes through, uh, is going to be beneficial, more inclined towards benefits to India, or it's going to be kind of a neutral or just a face wash. How do you see this deal, and how do you see this piece fitting into the future, how the markets are going to play in the next maybe 6 months or 12 months
Sure.
time?
So I think the bigger piece here is that whether you said whether this deal will happen or not. So the deal is going to happen. The terms of the deal are going to be crucial to
Yes.
understand. But if you see Indian investors' ka stance towards the trade deal, global investors' ka stance towards the trade deal, and general perception, there's been a big change in the last 2 weeks. After Modi ji, visited China, after he, Putin and Xi had a nice moment together, they met, they spoke a lot. After that, the entire stance, the whole offensive of Trump and US towards India
Became
completely
defensive.
changed.
Yes.
Defensive, soft, accommodative, friendly. So there was hostility and aggression before, and Modi ji obviously didn't react to any of it. He just played a master stroke. He silently went, he met other people, he tried to diversify our relations with other powerful countries in the world. And just that silent messaging, that he didn't respond to US directly. He passively did something else, and that conveyed a very strong message. And since that day, the trajectory of Indian markets have changed. The perception on Indian markets have changed. and the stance of US towards us has also changed. So obviously, if the biggest source of news now is Mr. Donald Trump's
Tweets.
Twitter and his
Yeah.
Truth Social or
So
something.
there's a happy birthday Modi ji
He
message
wished Modi
coming.
ji happy birthday also. He said we are friends also and we want to work to get the highest order of collaborative and synergistic policies in
Yeah.
place. So I think the direction is positive. When you make the most money, not when the best result is out. Only when the worst is over, that is when you make the highest money in markets, stocks, etc. We call that delta, right? So now over the last 2 weeks, lot of negativity has reduced and it started converting into positivity. So the delta has been very high. Now obviously a lot of hope and optimism is built in. So incrementally delta will be low. And finally, obviously, once the trade terms are announced, is when the uncertainty will reduce. And by that time, the market would have discounted most of it. But in the world of today, with India's might, with India's positioning, with India's relations with other countries, US was the only one who tried to first create some hostile tone towards India, which was unexpected, uncalled for. And I think that's going to change. US can't be hostile to India for a very long time. We're the fastest growing economy in
Economy.
the
Yeah.
world. Low inflation, low interest rates, tax cuts, GST reform, largest consumer base in the world of a good age, of a young age.
Of a young age.
So the overall status of India, backed by its demographics, backed by its statistics, is very strong for anyone to take a anti-India call. So I don't think this is going to play out.
So we are in the safe
A lot
zone.
of this is, we've seen it in the last 12 months. Most of it, whatever Trump has done, has all been negotiation only. He's never gone ahead with something aggressive and stayed with it for long. China also, he had imposed 125, 250% tariffs.
245% tariff. Yeah.
It didn't
Yeah.
pan out, right? China though retaliated aggressively. Finally, they settled. So eventually, we need to know that wisdom, common sense, and uh, basic economic logic will prevail in doing all this. So we don't need to worry too much about tariffs. Of course, it's a source of uncertainty, but it'll all end well.
So, like we say in our financial terms, the negativity for India in the global markets has bottomed out, and now the trajectory for the
Yes.
growth is going to come in. Yeah.
So in my Feb and March interviews and webinars and everything, all our quantitative models signaled that we didn't know that we were making the bottom in the market, but from an indicator perspective, whether it's we have a proprietary tool called our riskometer, and we have a set tool called centimeter, which conveys market sentiment. Then we look at a lot of breadth tools, we look at valuation tools. All of them converged into multi-cycle lows. So when you're at a low, you can't continue going lower. If you're in the bottom 10 percentile band, either you
So
stay
that
there or
risk
you
will
go
be
up.
risk will be very less in that band.
If you enter markets in that band,
Yeah.
your risk is low, and if things play out, your reward is
Reward is
very high.
very
If they don't, you don't lose too much. So it's a very good zone to be in. So from a valuation perspective, sentiment perspective, risk perspective, factor spreads perspective, everything had pretty much gone to lowest 10 percentile or near zero. That is a very good time to enter markets. So I'm not saying that we are bottoming out. We've already bottomed out. I'm not saying we will recover. We are already in our recovery journey. So now from bottom 10 percentile, we are already in the 25th or 30th percentile. So we are well within the recovery zone. Now, when do markets become euphoric and start topping out? When we go closer to the 80th, 90th percentile of indicators. So we are far from that right now. So it's a good zone to be invested. If you've not added, you can enter markets also right now. It's a good zone to be in.
But Siddharth, when we look at the domestic macros, okay, there's a GST cut, there's a IT cut, there's a RBI rate cut. There's so much of festive season now coming in, wedding season coming in. Everything looks like our consumption is going to hit the roof. Yeah, but still we see that the Nifty is still sideways. It's lagging at 24 to 25 K zone. So do you see that now suddenly we will see a shoot in Nifty, or do you see this sideways going in for a bit of time now?
So there could be a scenario where market like headline indices remain sideways,
Hmm.
but within that there is a lot of sector rotation.
Hmm. Hmm.
So our indexes are obviously have a lot of, I think 25-30% is financials,
Hmm.
15%, 16% is energy.
Hmm.
A lot of it is also infrastructure and industrials, and then there is consumption. So consumption sectors doing well is one thing, and Nifty going up is another thing. Over the last 4 or 5 years, who has borne the brunt, or the who has taken the burden of growth? PSU, public capex, industrials, capital goods, defense, infrastructure companies. All of this was holding growth for India. Now with tax cut, interest rate cut, GST reforms, the burden of growth is likely to shift from capex oriented industrial B2B infra companies, PSU companies, to consumer staples, consumer discretionary. So if this rotation happens, you will see a lot of money being made in some sectors, but not necessarily the index going up.
It will reflect in the index. It's not
It's
necessary.
not necessary
It's
that it will
not. Yeah.
reflect in the index,
It's
but
not. Yeah.
sector rotation can still play out.
Okay, fair enough. Okay, so moving, let's just move a little gears now. Moving to your strategies, you're running three PMSs, Aqua, Alpha, Multi.
Multi-asset,
Yes,
MADP.
multi-asset.
Yeah.
So I was looking at your fact sheets. Aqua and Alpha, fairly new funds, is around 2 years
Right.
now, and the multi
4
asset is
years.
around 4 years or
Yeah.
so. But Aqua and Alpha are generating better returns as compared to multi asset, which is your flagship PMS. So, is there anything specific that you're doing, or something different that you're doing? Are you going aggressive in that? Are you in the small or the mid caps? What is it? What is it that we as investors can differentiate between Aqua and Alpha as a fund and multi-asset as a fund
Got it.
strategy?
Sure. So actually, all three funds are completely different in nature. Their targeted return profile is different. Their expected risk profile is different. Just to simplify
Hmm.
it for you,
Yeah.
the multi-asset fund invests across domestic equity, fixed income, and precious metals
Mhm.
only via ETFs. There are no stocks in that portfolio. It's a low risk, moderate return strategy. The idea is for it to beat FD return with better taxation, beat inflation with better taxation, and over a cycle, beat just basic Nifty returns also. So, beating Nifty, beating FD, and beating inflation are the core principles of that. And the target return of that fund is 12 to 14%. It's a low risk strategy where we expect extremely low drawdowns, extremely low volatility, but we are not targeting 18-20% returns. We're targeting 12 to 14% returns. And if you look at the long term, 2 year, 3 year returns of that fund, it's 13.5%. So it's well within the
Within the target zone.
target
Yeah.
zone of that strategy.
Okay.
Another thing to understand is in events of extreme, equity downturns, volatility, the multi-asset fund will have extreme 1/4 of equity volatility. There are a lot of reasons
So
for
the
that.
drawdowns will be extremely less.
Extremely low drawdowns, extremely low choppiness.
Okay.
It's a smooth strategy, stable, consistent returns. In over a 5 year, 10 year cycle, if you want 12 to 14% sort of returns, then multi-asset is a very good strategy to start with.
Okay.
If you want stability and compounding, it's with low risk, this is the strategy for you. If you want high returns, this is not the strategy for that only.
Okay.
This is about smooth sailing, a smooth journey. No, your sleep won't get
No
disturbed.
tension
You
नहीं
have no
चाहिए अपने को.
stress. You have no worries. You don't know कल market 10% नीचे खुला तो मेरे पैसे. No idiosyncratic risk whatsoever. You're not taking a bet on a single company or a single sector for that matter. So there is no idiosyncratic risk whatsoever in this. So again, I'll just give you a couple of examples, right? So for the multi-asset fund, we have roughly 25 to 30% gold since the last 1.5 years. We have 5-7% of liquid allocation, and the rest we have in equity. So in the last, say, 6 months, if I just look, gold has also done well, and Indian equities have also recovered. So this fund has delivered 17-18% returns versus its benchmark has delivered 10-11% returns. Over a 2-year cycle, over a 3-year cycle, this fund has delivered 13-14% return. Benchmark has delivered also 12-12.5% return. But this has lower risk than the benchmark. So MADP is all about risk adjusted returns. Say in the month of Jan-Feb, Indian equities fell a lot. Small cap index fell what, 14%, 15%. Mid cap fell 10-12%. Large cap also was down 8-9%. When indexes fall so much, equity portfolios fall even more. So equity portfolios fall anywhere between 12 to 20% in a phase when indexes fall 10 to 12%, right? So they fall more. The multi-asset fund, forget it didn't, it fell roughly 2.5% in this phase. Why? My core allocation was to Nifty ETF in that phase, and 30% was to gold. Say 5-7% was to liquid. Gold went up, liquid held position. Large cap didn't fall much. So only the mid and small cap ETF took a little hit. But that hit got diversified away because of gold and liquid and large cap. So the diversification of multi-asset allocation gives you a lot of benefit in a bad phase. And in a good phase, equity also does well. So this participates. So a dynamic multi-asset fund is an all-weather, all-season strategy.
So that means your beta in multi-asset dynamic fund will be extremely low, under control.
Always your volatility, beta metrics will be low. Your Sharpe Sortino will be very healthy. But now what is the flip side to this? Say in the last 2 years, say last 3 years, my equity fund, AQUA, uska return is closer to 25-26% since inception versus benchmark closer to 18%. So there is a 7% alpha. So the target return profile of our flexi cap equity PMS is closer to, it's in the 20 to 25, 26. That's the range. The targeted alpha in that strategy is 5-7%. And we've backtested it for 20 years now, that strategy. And we've been live for not 3 years, but closer to 2.5 years.
2.5 years.
So that is a completely different strategy. The standard deviation or volatility of that fund is 20-21%. The volatility of multi-asset is 11%. So it's half the volatility of a pure equity fund, and returns are also lower. And MADP Alpha, which is our third fund, that targets a return profile between 15-18%, and with a risk between AQUA and MADP.
Okay.
So this is the lowest risk return strategy: 12-14% return, 10-12% volatility, 15-18% return, 15-16% volatility, 20-25% return, 20-22% volatility. So the risk profile and the return profile is different for all the three funds, and hence you can't compare them purely on returns. Why? In the Feb market crash, if you look at the 1-year return of AQUA, it will be minus 10%, for example. And the 1-year return for MADP will be plus 2%. So if you're comparing, then you'll say that return mein multi-asset is higher. But over a long cycle, we need to understand how the risk.
So this is very interesting that you have for all the layers of risk and reward, so that you every type of investor can fit in, can choose what fits in best for his requirements,
right,
and then step into your either to AQUA or to Alpha or to multi-asset.
That's right.
Yeah, that's
AQUA
brilliant.
is an alpha focused strategy. It is trying to beat the market over a 3-year, 5-year cycle, right?
Okay.
MADP is not an alpha focused strategy. What it is simply it's trying to diversify your allocation and give you more than inflation, more than FD with low risk. Equity like returns without equity like risk.
Okay. So talking about AQUA and Alpha, because multi-asset, you've told us that it's a low risk fund. That's fine. Talking about AQUA and Alpha, we have seen events like like COVID-20 crash, the Russia-Ukraine war 22 crash, the September 24 complete debacle happening.
Right.
At the same time, when we talk about the investor mindset, okay, capital preservation is the key, and it's very sacred for any investor. They will be very happy to see their money growing, but they will be extremely sad to see their money falling. Yeah. So how do you protect your drawdowns, or what happens in the scenarios which are out of control, and probably your quantitative analysis is also not able to predict certain macro events that are happening and which are affecting the market.
So, the first thing you hit it on point, that the pain of losing money is even temporarily
is much
much higher than the pleasure of gaining a lot of money.
Yes.
And capital protection only becomes important when the markets are down. When markets are giving you very high returns, at that time, nobody is worried about capital protection, risk management, nothing. They think it is normal, or they take it for granted that if, say, in my first year, I'll just give you an example. In the first year when we launched our fund, our 1 year return was 78%. Between July 23 to July 24, 1 year return was 78%, which was 3x of Nifty 50. Nifty 50 was 25 and 2x of BSE 500. So when you come out of such a year, you get a lot of AUM, you get a lot of inflows after this has played out, right?
And they
then
are looking
it's
at
normal, it's taken for granted कि
इतना तो आएगा
ही रिटर्न, और इतना तो रिटर्न आना नॉर्मल है, आई डिजर्व इट, ये मार्केट को देना ही चाहिए,
ये मेरा बर्थ राइट है,
ये बर्थ राइट है.
यस.
बट 15% ड्रॉडाउन आता है ना, दैट इज नॉट पार्ट, वो नॉर्मल नहीं है. तभी इन्वेस्टर का फोकस शिफ्ट, ये तो एफडी से भी कम नहीं है, एफडी से कम है रिटर्न, 10-8% तो होना चाहिए, या एटलीस्ट जीरो फ्लैट तो रखो, कैपिटल पे तो रखो. सो दे थिंक दैट 78% अपसाइड आया, that is normal, wo I deserve, but 15% drawdown I don't deserve. So this is not the right approach to look at equity, which is why we say if you want higher returns, this is the strategy. ये इसका drawdown ऐसा होता है, इसका volatility ऐसा है, the risk is higher and the returns are also higher. If you don't want high risk, you don't want drawdown, come to multi-asset fund. We can give you 12 to 14-15% return with very low risk, peaceful sleep, stable.
And don't expect a 78%.
नहीं आएगा उसमें. So जिस साल में Aqua का 78 आया था, उस साल में multi-asset का 24-25 ऐसा कुछ return. So it is 1/3 of that. But drawdown is also less. The only problem happens is people see 78, think that this can only go up, ये नीचे नहीं जाएगा, 78 के जगह पे 30-40 तो दे ही देगा. पर जब वो कैपिटल के नीचे जाता है, ड्रॉडाउन आता है, that is not expected.
That's not digestible also.
That is not digestible. So that is why I'm saying that when things are good, nobody cares about capital protection. People want growth. Only when things go bad, they suddenly worry that capital protection to hona chahiye. So ideally, people want a strategy which at worst can keep your capital intact and at best can give you whatever return. 50, 60, 30, 40% return.
But we are seeing that shift happening in the investor mindset now, where they're saying that, okay, we are investing for a longer term, 3 years, 5 year span, number one. And yes, we are ready to see a drawdown, which is in the range of 15%, 20%.
Yes.
That mindset is setting in.
It's getting in now.
Yes, it's a generational change.
Communication.
Yes.
Lot of, all of you guys, all of us are working hard to create this basic awareness.
Yes.
And we've had a few very savvy investors. When we saw sharp drawdowns, they added more money.
Yeah.
Those are the guys you want to salute to, because how much ever you convey in your webinar that, okay, last 1 quarter, portfolios down 15-18%. This is a great time to top up, because our models and indicators are saying this is a good zone for markets to turn, for risk to increase and all of that. And the markets are going to recover, likely to recover from here. Nobody cares, because they said once your last quarter performance is 15% positive, then we will talk. They want proof. So they are always chasing. They are chasing performance momentum, which is not the right thing.
Which is not the right thing. And I believe, yes, with a lot of awareness coming into the alternate space, especially, I believe
Hmm.
that we will see the mindset changing of investors very
Yeah.
soon. Yeah. Okay. Um, One last question for this podcast is that what message do you want to give to your investors? What new are you thinking for your strategies? Generating this alpha is, I think, the biggest challenge for any fund manager.
Hmm.
Yeah, and this is what creates your history and your all the records that the investor looks into as to what
Right.
happened. So, for example, 78% was a great alpha.
Which is a great alpha, which was a great year,
Hmm.
but it's not something we can
It's
expect every year.
something,
It
yes.
is a gift. I would always say it's the gift of the markets and it's a gift of the models. It is not something we've controlled and tried to,
Yes.
it is not
So,
intentional.
so I want to give a message to your investors as to what should they expect from your three funds uh, in the coming years, as to what is going on in the mind of the fund manager and what kind of strategies are you tweaking, so as to generate that extra alpha
Right.
that is required, that is expected from you.
Sure. So the core philosophy of me personally and within my
Mhm,
team is just three words.
mhm,
It's inspired by a Japanese concept called Kaizen. But the core philosophy is continuous learning, continuous improvement, and continuous evolution. If you are focused on these three pillars, right, then irrespective of what life throws at you, you will learn from your hardships, you will improve your models, and your models and portfolio will keep evolving in the new world order. And the new world order is more data, AI,
mhm,
the information asymmetry in the market is reducing.
mhm,
Markets are becoming a little more efficient.
mhm,
Investor mindset is changing. Retail participation is increasing. Mutual funds, SIP flows are controlling a lot of market. Maybe in the next decade, passive flows will control a lot. So things will keep changing. We just have to stick to three things. Learn as much as you can on a daily basis. Be a curious student of markets, of quant, of
mhm.
whatever. Try to incorporate those learnings by improving your models. And because of that improvement, you are continuously evolving. So if you keep these three principles, you're doing the best you can for yourself also, and you're doing the best you can for your investors also. And it is usually tough to predict and get everything right. But our broader goal is, if we take 100 decisions, we want to get 65 of them right. 35
Fair
we
enough.
will get wrong. There is, how much ever you predict, whatever science, quant, whatever you do, you can't have a 100% strike rate.
Yeah.
So, first, having a realistic target,
Mm.
that is very important. So, 65-35 of right to wrong decisions is good. And live performance and historic performance backtests also suggest 65% of quarters we do well, 35% of quarters we underperform. Our entire goal will be to take this 65 to 66, 68 and reduce that 35 to 28, 30, 32,
And be
whatever.
realistically happy about
Realistically happy.
hitting that goal.
Our long term alpha target is 5 to 7% versus benchmark. In our live environment, we are in that range. Our long term returns is 20 to 26. In our live environment, since inception, we are at 25 or something. We are in that range. So stick to that targets that we've set for ourselves and continuously try to improve your models, find more sources of alpha.
That's brilliant. It was great speaking to you, Siddharth, and I'm sure that the viewers are going to
Yeah,
benefit a lot
likewise.
from your experience and from all the questions and the answers that we just
Yeah.
discussed. And we wish you all the best for your PMS and the upcoming AIF.
Yes.
But just before we leave,
Sure.
okay, I'm going to have a rapid fire question for
Sure.
you, and there are
Excited.
two conditions that I have.
Okay.
Is that there's no time to think,
Okay.
and also I just need the one word answer.
Sure.
Okay, so
Let's
no
do it.
explanation, no
Done.
ifs and buts,
Done.
just the one word answer.
Done.
That will come straight from your heart.
Okay.
Okay, and let's see how this rapid fire plays out. Are you ready?
Ready, ready. Let's do this.
Okay, so the first question: gold or silver?
Cold.
Nifty 22 first or 30K?
30.
uh, the best sector?
Sector rotation.
Okay. mm, Small and mid caps or large caps?
Large and mid.
All right.
80% of our portfolio is large and mid.
Okay. Okay, that's great. Mm, man or machine?
Man with machine.
All right, that's great. Super. We wish you all the luck for man with machine.
Thank you
And
so
I'm
much.
sure that this combination is going to be fantastic and
Absolutely.
is going to generate brilliant alpha for the investors and for everyone around us. And
Thank you
that's
so
what
much.
we're looking forward
Thank
to.
you so much.
And sure, would be catching up again and
Done. Looking forward to stay in touch.
discuss the financial markets for the benefit of our
Absolutely.
viewers, our
Whenever.
investors.
Thank you so much. It was a great session. Love
Thank you.
speaking.
Thank you so much. So, we've had a wonderful podcast, but would like to say that a small disclaimer that all the things that we have said is for educational purposes, and the viewers, the investors, are requested and instructed to please take your own decisions while you're investing.